Good afternoon and welcome to the Future of Finance. Today our discussion is on CBDCs are poised to administer the coup de grace to the payments business of the banks. I shall now hand you over to Dominic Hobson and the panel. Thank you.
Hello everybody, I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar. CBDCs are poised to administer the coup de grace to the payments business of the banks, or has reform of cross-border payments lost its mojo? Whether CBDCs are the answer, and probably not, at least in the short term, it's certainly worth asking whether central banks and other regulators are losing patience with the relatively slow progress on making cross-border payments cheaper, faster, and more transparent for everyone. And I say everyone because clearly the current system is working well enough for some people, particularly those in developed markets exchanging value in the top few reserve currencies. It's poorer people paying remittances, for example, and dealing in smaller currencies, which are paying the price of inefficiency. Making cross-border payments faster, cheaper, and more transparent for them has support at the highest political level. Indeed, it's a G20 priority. And rightly, not just for poorer people either. Efficient payment is good for all of us because it is vital to continuing growth in world trade, particularly as more and more trade moves online. Yet progress does seem to be getting bogged down. When we last visited this topic in September 2021 in a webinar entitled "It's Time to Fix Cross-Border Payments," the 19 building blocks laid down by the CPMI for making cross-border payments faster, cheaper, and more transparent were already more than a year old. They were published first in July 2020. Now they're almost 2 years old. The latest FSB review of progress I could find, that was published in October last year, against those 19 building blocks. I counted 8 surveys, 2 reviews, 2 hackathons, 1 workshop, 1 proof of concept, 1 cost-benefit analysis, 1 promise of technical advice, 1 deadline extension, and 1 shrug of the shoulders. That was on CBDCs. We have these 4 quantitative targets to settle cross-border payments faster, cheaper, and more transparently. And all they do really is restate the goals of the program in the first place. So what's going on? Why is it so hard to solve this problem? To help us understand the issues, we're joined by Daniel Eden, an advisor and solution architect at the Bank for International Settlements Innovation Hub, which he joined from R3, and where he builds technology for central banks with a special focus on blockchain and CBDC. Angus Fletcher is Chief Executive Officer of Finality UK, the first local jurisdiction in which an online blockchain payment owned by 15 global banks is going live. The long-term aim is to establish a global network of distributed payment systems capable of settling the cash leg of tokenized transactions. Ankush Sharma is a product manager in payments at BCB Group, a leading crypto business, banking partner, and provider of payments and trading services for the digital asset economy. Gottfried Liebrandt is a payments expert, former CEO of Swift, an alumnus of McKinsey, and author with Natasha Dutrad of this excellent book, which I urge everybody listening to read, The Payoff, How Changing the Way We Pay Changes Everything. Now, in addition to our panelists, we do, of course, also have you, our audience. We want your questions, we want your comments, so send them, keep sending them via the Q&A functionality at the bottom of your Zoom screens. As always, rest assured, I won't be saving those up to the end, but we'll address them as we go along, so you can be an integral part of the discussion right from the start. And I speak for all of us when I say we're going to be very disappointed if we don't get lots of questions and comments from you. I'd like to begin by asking Daniel if I'm being unfair in saying that things are proceeding too slowly. After 2 years, as I said, the only concrete progress we really have to show is these 4 quantitative targets for 2027, which is itself 5 years from now. And one of them is speed. 75% of payments we settle within an hour, which doesn't, to me, sound particularly demanding. I don't know whether the data exists, but I'd be surprised if, particularly in the major currency pairs, we're not at 75% or more already. Secondly, cost. The global average cost of retail payments is to be no more than 1%, and the global average cost of sending a $200 remittance to be no more than 3%, which again is a measure of how far we have to go, perhaps. Thirdly, access. The financial institutions and end users are to have at least one option for sending and receiving cross-border payments. More than 90% of individuals who wish to send or receive a remittance payment are meant to have access to a means of cross-border electronic remittance payments. Finally, transparency. All payment service providers are to give a minimum defined list of information to payers and payees, things like the total transaction costs and how long it will take to deliver the funds, which will, intention at least by 2027, is we'll have a kind of floor of transparency right across the global marketplace. So, Daniel, my question to you is a kind of two-parter, really. One is, am I being unfair by saying that progress on the 19 building blocks has been too slow? And secondly, as I look at these 4 quantitative targets, does the data actually exist? How are we actually going to measure performance against those 4 quantitative targets?
Okay, that's a great opener, and I'll do my best. I'll do my best to give some insights. First of all, I mean, thanks for having me. It's wonderful to be
Thanks for being here. It's great to have you.
Present with such esteemed panelists. I'm looking forward to the conversation. I always need to remind myself to say that the views I represent are mine alone and not necessarily the views of the BIS. So now that I have that out of the way, I'll do my best to. I mean, there's 2 questions. Is progress too slow? Is that a fair statement? And what's the quality? Are these the right targets? And what's the quality and the measurability of the targets? Being part of the BIS Innovation Hub, I would say that progress is slower than I would like, but that doesn't mean that progress isn't being made all the time. You opened the panel with saying that, it seems like, the G20 roadmap with the 19 building blocks came out almost 2 years ago, and it seems as if progress has been slowed down. I think I would make an analogy to kind of last mile challenges. So, when you're writing a paper, you get to 80%, you make progress between 0 and 80 pretty quickly, and then it's that last 20% that seems to kind of take forever. I think as we mature a lot of the technology around this and we get closer to the finish line, it's exactly the same. The finish line almost seems to be getting farther and farther away. And the reason is we're asking more nuanced questions. Things get added to the scope that maybe weren't added before, and it's a moving target, and the industry around us is also moving. I mean, if we look at the swings in the value proposition that crypto brings, for example, having this conversation right now versus having this conversation a couple months ago may have maybe changed the views of our fellow panelists here quite substantially. So with a moving landscape and a moving target, I don't think it's unfair to say that things aren't moving fast enough, but that doesn't mean that things aren't moving relatively quickly. So I think we are making very, very good progress. I think some of the challenges in particular with cross-border payments is that to a certain degree, they are predicated on advancing national payment schemes, right? So if you want to start talking about cross-border payments, the general notion is that, well, we need to advance our own domestic payment schemes with an eye towards connecting them together in some form, either as a single platform or as a hub and spoke. And there's many, many, many different models. But you get this kind of uneven and asymmetric tapestry of different jurisdictions, and that causes a very different advance in pace. So the question really is, how quickly do you move along? And you've already mentioned that maybe in some economies, the problem is, for all means and purposes, in certain currency pairs in some regions, already there, right? As for the targets, I mean, I think the targets of speed, cost, access, and transparency are the right things to talk about. I think with the quantifiability and measurability of those targets, I think it's going to be incredibly, incredibly hard. But any target is better than no target. And until we can produce a more nuanced measurable metrics, I think that these serve us well in moving towards the general direction. So that I'll stop there.
Gottfried, you've listened to what Daniel said. It reminds us all that actually cross-border payments are an amazingly complex, multi-layered industry, and we've got, 190, 200 jurisdictions on Earth, all with their own domestic problems to solve. So what is your reaction to these 4 quantitative targets? Are they just simply too crude? Would it be better to have a wider range of targets aimed at different payment channels, if you like?
Yes. So thanks again for having me. I somehow sense that I'm the token dinosaur on this discussion, so I'll happily fulfill that role. You
don't work for Swift anymore. There's no need to describe yourself as a dinosaur.
That's not what I was referring to. This is the whole notion of an expert. I would say though that the landscape is complex, and one of the I think concerns I have with the approach of the whole roadmap is that it takes a cross-border payment as a cross-border payment. And I think it would be fruitful to at least segment the landscape because it's comprised of a whole set of different types of flows that have their own challenges. And I would segment it at least along 2 dimensions. I would distinguish sort of wholesale versus retail, if you want. And there are much finer distinctions. You have the high liquidity, the multi-billion-dollar flows, and all the way at the other end, you have worker remittances that are maybe $200, the one that the targets talk about. The other dimension, I think, would be by corridor. Cross-border has always been about currency corridors, and there you should at least distinguish mature to mature or big currency to big currency from the other ones. So I think it's fruitful to break that up. I think the focus of the FSB and thereby the CPMI has been very much on worker remittances, i.e. smaller flows, and especially those between mature currencies and emerging markets. And I think they are almost an issue in themselves. The solutions that you have for those are not necessarily the ones you have for others. So to take them off, I think the problem of timeliness, for example, in the large flows between reserve currencies, as you mentioned, I think GPI solved a big part of that. Many of those flows are now done. I would be surprised if the 75% target is not being met already. I think most of those are done within an hour, especially if you weigh them by size of payment and by currency pair. So there are sure challenges there, things like RTGS opening times, and we can get into that. But the challenges are from a different nature than for the smaller ones. Another example, RTGS opening times would be a good one. That problem you can solve in different ways. I think for the smaller currencies, the smaller amounts, I should say, the solution that has been found in Australia and in the UK with faster payments, where you take essentially a subset of the RTGS that you keep it open overnight for smaller amounts with collateral posted before the weekends, etc. That seems to work. Of course, that only works for smaller payments. It won't work for large liquidity flows. So again, I think there segmenting the market really adds to the discussions, and the solutions you come up with may also be different depending on what you're talking about. Mm-hmm. So that would sort of be my.
Thanks, Godfrey. For anyone who doesn't know, GPI is the transaction management platform offered by Swift, which enables those high-value cross-border payments to be managed actively during the day to speed them up, cut the cost, etc. Angus, perhaps I'd come to you next. One of the requirements for meeting these targets is, of course, that central bank RTGS systems have to change and perhaps become open to a wider range of participants. Now, that's a subject which I'm sure is close to your heart as a non-bank looking to access an RTGS system. Am I right to think there's very little chance of a sufficient number of central banks actually adapting their RTGS systems to make achieving these targets possible within 5 years? Am I again being too cynical and unfair? Maybe there's better solutions, easier.
Yeah. So the way I would put it is that each of the central banks are very much looking at, and in particular, if you look at Bank of England, if you look at ECB, they're looking at how to upgrade their RTGS systems as we speak. They have significant programs associated. They're looking at different ways of how within that the different sort of standards, so rollout of ISO 20022. They're looking at different ways of connection. So if you look at the RTGS renewal program in the UK, there's a whole set of work around API connectivity, for example. So a different way of connecting in. I think the challenge for ours is that there is a start of a day and an end of a day concept that exists within within each jurisdiction, understandably, and that does create restrictions around, in particular, when there is restricted access as well into each of those RTGSs, who can access or not, and that creates restrictions on a cross-border basis as to when settlement can and can't happen. The interesting thing is, again, if you look at what has happened in the UK with the announcement of the Bank of England omnibus account policy is to create an account that effectively allows an ancillary payment system to connect in. And as long as you pre-fund that account, you can effectively operate a payment system off the back of that RTGS system on a 365, 24/7 basis. That obviously requires the funds in the account to be able to do that. But it creates a new way of being able to operate outside of those RTGS hours. I think when you then connect another payment system in a location that connects into another central bank in a similar way, like you can already in Europe, for example, you can then really operate on a cross-border basis, and I'm talking high value here, cross-border basis outside of those RTGS hours, so creating a different solution. I was also going to pick up on the sort of 4 points here. One of the other, and what Hotfried said around, you have to differentiate different types of payments. There is also an element of what is the payment being made for, i.e., is it to support a settlement of a new type of asset, for example, in a new type of market that operates on a different time frame, time zone, potentially as, again, 365, 24/7. In order to be able to provide support in that for the settlement, you need to be able to, have systems that can offer that. And I think, therefore, the industry is going to drive a big degree of a direction around the types of solutions to be able to facilitate that too.
Okay. You've heard what Angus had to say there. I'd be interested in your views on non-bank access to RTGS systems, but I'm also interested in what you think about this question of RTGS systems having to change. Simple things like extending their opening hours, for example, but also changing their technical standards. What my question really is it's not just central banks have to change here. If that happens, private banks have to change as well. So what are your thoughts, A, on non-bank access to RTGS systems? And secondly, how confident can we be that the private sector banks are going to be enthusiastic about meeting these targets by changing their systems to work with RTGS systems which have themselves changed?
Sure. So I think let me just first answer the part around the RTGS extension, extending times and stuff like that. But before I answer that, I just wanted to kind of piggyback on Angus's question, right? RTGS access and extending that would probably be useful because there is, as we said, there are certain new markets that are coming up which need that flow and that liquidity and that access to those settlement across 24/7, 365. Now, the industry, as Angus said, the industry is already evolving. And I think the private sector is actually, in my view, is lurging ahead in rather than the central banks and the RTGS system by creating these networks, fragmenting networks across different geographies. For example, in BCB, we have our own payment network that runs 24/7, 365, which is called as Blink, and we allow that people to, counterparties to settle across the weekend as well. And then within different geographies across the globe, there are these networks that are spinning up. I don't think so the private industry or the private sector is going to wait for that long for the RTGS system. Obviously, RTGS extension and RTGS opening time being expanded will be useful, but I think there is already a parallel process wherein the private sector is getting up and kind of probably, I wouldn't say lurging ahead, but almost going side by side, trying to resolve this issue because they can't wait for the, so many different 190 or different authorities to kind of come together and establish this. So I think that's one thing. On your point around private banks, I think the issue with private banks is the non-banking institutions, when you compare it to private banks, their focus is, they are very much, I feel they're very much aligned to a certain kind of a notion or kind of a principle to say they are payment focused or they want to expand into new geographies or they don't have this whole burden of regulatory frameworks and the kind of challenges that they face, the microeconomics and the microeconomics challenges that the banks are facing. And in terms of extending the RTGS or making cross-border, I feel personally it's not at the higher at the priority level that it should be. But that's my view. So I think RTGS will probably get expanded. The RTGS opening times and RTGS functionality will get more and more better. But I think private players, and especially the non-banking, will probably go ahead and will establish a parallel network.
Mm-hmm. Thanks, Agan. I had an interesting question here from John Folk at Bourse Consult. And I think it's one really for you to address first, Gottfried. It's given all the flows and channels possible, are there too many options a bank has to consider over their current offerings? Is it a case of watch and wait until a consensus solution appears? In other words, is there just too much choice and too much complexity here? We were talking to one of our supporters at Future of Finance, who was trying to put together a directory of various technologies and payment systems around the world. And I think he'd reached a total of 20,000 different technologies, techniques, methods which you could use. So it is a very complex and highly fragmented area. But is John's question is, are the banks getting horribly confused here? We're giving too much choice. Is that fair?
Yeah, I don't know. I mean, to be honest, that's why we have a market to sort that out, right? I would say having too much choice is an easier problem to solve than having not enough choice at the end of the day. So there, I would say the payment landscape is going through faster change than at least I've ever seen before. So we're in a stage where lots of people are inventing things. So you would expect and you would hope that there are, like, it can be an explosion of species, and you have all these options. And I think it is the task of players like markets and others to sort that out. And I trust they are able. They're able to do that at the end of the day. And we'll see what floats and what answers to the needs. Having said that, it is a complex landscape, and it is precisely, I mean, I've always learned that the best way to fight complexity is with other complexity. So it may take very different solutions to solve what is inherently a complex problem with all these different flows for different purposes going around. Mm-hmm. But and it's good to hear from John Falk again, by the way, I should say.
Yeah, banks still have to make choices. They have to spend their money on something. They could spend it on, matching technical standards with RTGS systems or something else. So the market may not work as efficiently as we'd like, as quickly as we'd like, but that's a whole different discussion.
Dominic, can I just follow on from Gottfried there? I mean, I totally agree with his points, which is, the market will decide what succeeds and what fails ultimately. There are obviously certain rails that that can and can't be used, but the reality is there is so much only so much investment to go around. If it's going to really decide on who puts the funds in to keep these things going, and a whole host of them are going to fall by the wayside. So I think it's it will be market factors that change things, but I'd also agree that what's important is to see lots of different models and see which ones will play out. And there are learnings that can be taken from, all of the different types of models, different proof of concepts that are being looked at, and that can then, I think, build into the ones that are ultimately going to survive.
One of the drivers here, Angus, but before you go, I'd have thought is going to be the cost of liquidity. It's one of the 19 buffers here is trying to arrive at reciprocal liquidity arrangements or building liquidity bridges. Because at the moment, you've got banks who are parking possibly trillions of dollars of excess liquidity in markets all over the world just to make sure that they can meet their settlement obligations, and that's obviously that has capital costs as well as interest costs, which can only get higher as interest rates go up. And we've got HQLAX trying to address this question by tokenizing different forms of collateral. Is that a model which the payments industry could adopt? Tokenization of stuff lying around, cash and collateral lying around?
Well, I think it, again, there are potentially different models that tie in there. I don't want to sit and plug our solution, but, I'm going to.
I haven't realized I was bowling you an underarm ball here.
Exactly. In essence, the whole, one of the key benefits that around the finality solution is the ability to set up peer-to-peer networks in each market, which then interoperate on effectively the same technology with another, with each of the other peer-to-peer networks. Key is obviously the access in terms of those players will need to have access to each of the different payment systems in each of those locations. But by setting that up, you take out a number of the intermediary flows so that you don't actually have to park funds with multiple correspondents on a cross-border basis. The second thing is by the technology allows a near instant settlement. So again, you have far more freedom and options to be able to move funds both intraday, overnight, and again outside of normal working hours. And that's going to be, it's something that all of the consortium members within the Finality initiative have invested in for that very reason, that it's going to be one of the key drivers around the changing of their or allowing them greater options within their liquidity model.
Mm-hmm.
Just to add on that, Dominic, if you don't mind, I think I kind of agree with Angus, and although I don't want to, but I have to probably talk about our network as well, because Blink kind of offers the same sort of facility, wherein if you are part of the network, it not only allows you to kind of do transactions across counterparties. So it reduces the risk that kind of exists with counterparties, because you are having an instant payment system. You're getting payments instantly. It also, going back to those 4 pillars, it reduces the cost, because we offer it for free for that matter. So no matter how big the transaction is, which currency you're trying to do, whether you're using a USD or a euro, it doesn't matter, because as long as you are on the network, you can move across funds instantaneously. And also it probably talks about the access aspect of it as well, because right now, as I said, it's limited to what BCB can offer, but then it's not going to sit there. We are looking at it as an atomic network, something similar to what Angus was saying, and that atomic network is self-sustaining. So tomorrow we can see that network joining up across different other networks that are coming up by different geographies in the US, in Asia Pac, in Middle East, and then that becoming like a big network in itself, wherein cross-border payments we could be probably looking at within seconds, and it could be as low as £1, and it could be as big as a £1 million moving across the globe.
Thanks, Anka. Now, we're going to have to talk about correspondent banking and indeed CBDCs in a minute. Before we do, I'd just like Daniel to just get your thoughts on some of these other building blocks. I picked some out because they strike me as particularly intractable. One of them is this need for consistent customer due diligence. In other words, the KYC, AML, CFT sanction screening checks, which are pretty well recognized obstacle to efficiency in transactions. And the FSB paper talks about setting up data sharing utilities. We have some of these in existence already. Swift has one, for example. But there's no mention there of digital identities, even though the G20 and the FATF themselves have actually endorsed the idea of G20. And I thought that would massively accelerate the efficiency of running those checks. So I'm interested in your thoughts on that. Secondly, the second one of these building blocks is the adoption of ISO 20022, which is in principle a very good idea, but it's an incredibly long-running saga with multiple versions of it, very patchy adoptions of it, even by the payments industry itself, which is ostensibly undergoing a kind of compulsory move to it. Nobody really expects the entire industry to adopt it. And I wonder whether you think that this project, the engagement of the FSB and the G20, can actually change attitudes towards ISO 20022, particularly in the light of the experience we've had with LEIs, which had full high-level political support, but have failed to achieve universal adoption. In fact, it's another one of the things here. So, what's your thought about the customer due diligence building block? What's your thought about the chances of ISO 20022 adoption accelerating?
So the customer due diligence aspect is really a good one. I mean, if you think about today, where the onus lies for implementation and what's the recourse if anything goes wrong, I mean, it really is all on the commercial banks, right? So I think it's really interesting from a central banking perspective to understand how to promote global stability, payment systems that are harmonized cross-border, but at the same time understand who are the real experts at implementing KYC, AML, and CFT regulations, and how do we understand the pain points and the use cases there and advance on them. The fragmentation that we see with the implementation there is significant, and I think that it's going to be a constant challenge. You know, your point that you make on digital ID is probably one of the reasons that retail cross-border payments are moving much slower than wholesale cross-border payments, because you don't have to tackle that problem head on. And this is one of the last mile kind of components that I mentioned at the beginning of the conversation, is that once you get past the technical feasibility and you think about the user viability, you bump into these things very, very quickly. So, you know, data sharing techniques, like you mentioned, are an option. Can you align the incentives of all the players to adopt these kind of techniques and maybe share some of the requirements around these? I mean, that's going to be an ongoing challenge of aligning incentives across different jurisdictions. You know, it's nice that we kind of position these things as very binary, right? You have, you know, traditional payment infrastructure. You have kind of new age things. You know, you mentioned CBDC to begin with, but a more nuanced approach is also to understand, well, even if we can identify the target that we would all like to see, how do we, you know, take incremental steps towards that target and hit certain thresholds on the way that bring in that network effect, that bring in the adoption, that harmonize some of these broader things, and that's also a challenge. On ISO 20022, I heard somebody just the other day say that it's an aptly named standard because it has taken almost 20 years for some of these to see adoption. I thought that was entertaining, but again, I think it's an incentive issue. The onus on adoption is not there. The incentive alignment is problematic, and you mentioned yourself that a lot of the adoption actually happens just to be compliant, and it's forced by regulation. And you know, as you know, wearing the hat of the innovation hub, I think a probably better approach is to incentivize institutions to move towards new standards in a way that actually promotes their business model. And I think one thing that we don't talk about enough is what new commercial opportunities are there once we have a baseline that is innovation friendly. So instead of thinking about it kind of in like a zero sum game, you know, are CBDCs gonna work? Are they not gonna work? How to look at it as a gradual transition, understand the thresholds and where that tipping point is into new systems where you get the network effects, and spend more time thinking about incentives, and then you get adoption almost for free. So ISO 20022 is a great step forward, but I question its relevance maybe once we start talking about other building blocks like new financial market infrastructures and maybe CBDC more broadly when we get to that topic as well.
John Falk has followed up. He says, I'm hearing from the panel, I think we're going to end up with multiple networks. Good old spaghetti. This introduces risk, both systemic and technical. Are the smaller networks going to be up to meeting the requirements of being a critical financial market infrastructure? And I guess that's a reasonable question. You know, as the industry fragments and payments remain crucial to the functioning of entire economies and indeed the global economy, there is a risk of things starting to fall apart. I don't know whether you want to comment on that, Daniel. But
I'm happy to take the lead. I'm sure my fellow panelists have something to say as well. I mean, the fragmentation in the marketplace today is also incredibly significant. Yet, you know, I think the majority of us would agree that under normal circumstances, it operates fairly well in most economies. So if we put that as a benchmark in terms of fragmentation, I think we can absolutely do better than that. And I don't think that the world ahead of us is more fragmented than the scenario that we're living in today. So I think we're very much headed in the right direction. But it's again a balance, right? We want there to be diversity in payments. We want there to be diversity in assets. We want there to be choice to end customers. Yet we don't want that to lead to fragmentation and any of the negative side effects. So I think we need to balance it carefully, but I don't see a problem as long as we're aware of fragmentation and networks and stranded assets as we proceed towards the goal.
Thanks, Daniel. I'd like to talk about correspondent banking now. And I'd like to ask a very specific question about it. As I look at the CPMI building blocks, number 13 says, pursue interlinking of payment systems, i.e. decrease dependence on correspondent banking. Number 17 says, consider the feasibility of new multilateral platforms and arrangements of cross-border payments, i.e. further substitution of correspondent banking by these bilateral or multilateral links. And it's pretty clear from my reading of these documents that correspondent banking, as presently construed, is seen as part of the problem. They've got very high capital costs. They've got relatively inefficient processes for establishing people's identities. We were talking about KYC, AML a minute ago. They have funding costs, the liquidity problem, which Angus was talking about. And of course, they've got very wide fat FX spreads, which they're collecting as well, particularly in those less liquid currency pairs, which affect the remittance market in particular. Now, there are solutions like Swift GPI, which Gottfried has brought up, which are helping those correspondent banks to become more efficient in managing those payments and actually get the processing times down and the transparency up and the speed up and so on. But is there a sense here that the regulators actually wouldn't mind getting rid of correspondent banks altogether from cross-border payments in the long run? Angus. Then Gottfried sure has some thoughts.
Yeah. I think there is a role to play for multiple parties in this landscape. In certain markets, I think it makes absolute sense to have correspondent banking relationships. There are more risky markets that, frankly, some of the larger markets would not want directly connected into their own broader markets, based on the fact that it could create financial stability risk issues, for example, for them directly. And they are probably quite comfortable that certain commercial banks take the risk and price in the risk associated with those particular markets. But I come back to the point I made earlier, which is it's also about, for me, it's about what is the purpose of what you're using a cross-border payment for. And I think on that basis, what's really important there is, again, what's the right solution for that? If the intention, say, for a wholesale payments is to improve your liquidity, to reduce your cost, to improve your settlement risk by reducing down settlement time frames, and to increase your options to be able to link, for example, delivery versus payment transactions with cross-currency swaps intraday. The correspondent market doesn't suit that very well. Let's be clear, and other solutions in the market are going to. So I'm not convinced that central banks necessarily want to remove correspondent relationships entirely from every single flow. I think it's around, where does it make sense to remove them, for what purpose?
Gottfried, what's your thoughts on the usefulness of the correspondent banking industry going forward?
Yeah, so I first of all, what the central banks want with correspondent banking, you have to ask the regulators. I wouldn't know. I agree with Angus that it would be. I agree with the general gist, which is good for some, good for not so good for other segments. But I disagree on the segments probably with him. I think at the low end, we've already seen correspondent banking. First of all, I don't think it was ever there, and much of the growth is happening on non-correspondent networks, right? Western Union, TransferWise. There's a whole host of players that serve that market basically by acting as their own correspondent, by having accounts in multiple countries, but I wouldn't call them correspondent banks. So I think there at the low end, you've seen a whole host of solutions. The interesting question is the high end, and maybe I wouldn't focus on the remote currencies. I would actually focus on the reserve to reserve currencies. And to be honest, one of the key insights is that even the large banks, even the global transaction banks, many of those self-clear only in their own currency and rely on correspondent banks for all the other currencies. So even for reserve to reserve currency, when you get to the highly liquid flow at the top end of the market, correspondent banking is very much the model. And there, I think the regulators will be quite hesitant to let that go. It gets almost to the notion of commercial bank money and the model behind it. We rely on these banks that provide liquidity by using their money creation powers at the end of the day, which also underpins their business model, to be honest. And if you look at the regulators, I think they're very hesitant to get away from letting people clear that they don't have supervisory oversight over. And for that matter, I wanted to get back to the omnibus account that the Bank of England has introduced that Angus was mentioning earlier. If you read the fine print, you'll see that the devil is in the detail, and you'll see that they've restricted it to an enormous amount. One, they do not allow overnight positions in it unless you're a regulated bank by the Bank of England. Second, you can only be putting money in and out of it, again, if you're part of whatever they call the monetary supervisory framework, i.e. you're a UK regulated bank. Now, we can argue how this is going to work in practice, but you'll find that they are quite hesitant to let that go for systemic risk, monetary policy. There are a whole host of things where they sort of like having the correspondent banking model, where they have only access to banks that they supervise, that they know meet their KYC requirements. There's a whole host of considerations there. And I think that's an interesting one to dive into, because that's a problem that's not going to go away if you tokenize it. It gets to the heart of how they run their reserves.
We have to talk about CBDCs in just a second.
Well, it will come, that will be exactly the same discussion. Who has access to the CBDC?
Yeah.
Well, you'll find that will be the crucial discussion. And I will tell you that unless they're cowboys, they will not allow any Dick, Tom, and Harry to have access to that CBDC, at least not for high amounts.
Okay, well, one of our member of our audience has asked a question specifically about this, which I'll come to in a second. But Daniel, I can see you want to say something. But Anke, perhaps I could just bring you in on that point which Gottfried has just made about the regulators want to regulate big banks because it gives them a greater degree of assurance, if you like, and putting it somewhat crudely there. So what are the chances of banks being displaced, particularly on the retail side, by, I don't know, social media, telecoms companies, some of these fintech startups, simply because they create a better user experience? Is there going to be a sort of halt on that due to central bank concern about the stability of the system?
I don't think so. The bank's going to get displaced. I think there'll be a place for banks as well as these new, whether when you talk about fintechs or other providers. One of the great examples is how in African nations, M-Pesa, which is being run by, I think, Vodafone, has kind of given the access. It basically has become one of the most powerful mechanism of moving payments or moving funds across retail, especially because a lot of these people in those countries are unbanked. And for them to go and access those banking services, they do not have that capabilities or means to do that. Whereas, the teleco providers in that case, offering that M-Pesa route has given that the option. Similarly, if you go to some of the Asian countries, and India, for example, not everybody probably will have. I mean, some of the most unbanked people, India is probably on the third or the fourth level if you look at the unbanked. But then, the likes of Paytm and the likes of RuPay have kind of given that ability for people to make the retail peer-to-peer payments. So I don't think so banks gonna get displaced, but I think there'll be a lot of competition. That is why banks will have to probably innovate a lot more. They'll have to probably look at how they streamline, use better technology. I still think a lot of the issues that we have been discussing can be resolved using blockchain and distributed ledger in terms of reducing the risk and making transactions fairly quickly and in time. And then also the banks will probably have to look at how they kind of work together in terms of giving a healthy competition to the private sector.
Daniel, you wanted to say something, I think.
I wanted to make a point about the correspondent banking model stuff. There's a great BIS paper. I'll do a shameless plug to it for a BIS paper called The Retreat of Correspondent Banking. And I think, at a high level, basically what the paper shows is that when you look at the world map and you look at the number of correspondent banking relationships, they are decreasing. And when you look at the number of flows, the value of flows that are going through those relationships, they primarily are also decreasing. And it's largely a process of de-risking. And if you zoom out far enough, you realize that the cross-border correspondent banking model at the end of the day is a private sector, commercially motivated business. And the question for central banks is really, is that okay? Is that okay? Is that okay to rely on the private sector and commercial motivated incentives to connect currencies cross-border? And that's an open question, and I don't have the answer, and the answer may vary by region. You mentioned two building blocks. You mentioned building block 13, interlinking payment systems, and you mentioned another building block about
17,
new FMIs,
yeah. Mm-hmm.
17. I think I just wanted to emphasize that when you look at, for example, interlinking payment systems, one of the projects that's going on in the Innovation Hub is called Project Nexus, where we're interlinking two different payment systems. And yesterday, I sat down with Sukmendu from the MAS, and he was talking about interlinking between prompt pay and pay now in Singapore and Thailand. And he was talking about the process, and he said it took 3 years to connect two faster payment systems. Now they're trying to connect to another one, and their target is about 6 months. But the idea here of connecting faster payment systems, well, first of all, it's a wonderful idea, but it actually, Project Nexus tries to tackle the problem of how to do them in a way that actually scales. But connecting faster payment systems doesn't relieve the clearing and settling underneath them. So actually, correspondent banking models and interlinking payment systems are not at odds with each other at all. Okay, it is just a messaging layer when you think about interlinking payment systems. That is not the case for 17. 17 new FMIs that cut across borders. That indeed is to some degree at odds with correspondent banking, maybe when you look at financial stability for good reason.
So I'm clear on this point, Daniel, that you can't disentangle hooking up retail instant payment systems from the RTGS systems, because those payments have to be netted and then ultimately settled inside the RTGS system. In other words, actually instant payment is an illusion.
That's exactly correct. Yeah.
Okay, great. We should talk about CBDCs. We're into our last 15 minutes, and our audience will be very disappointed if we don't. In fact, a member of our audience has said, does the panel see a world of CBDCs being used for FX? And if we take him to mean that, what role do they have to play in cross-border payments? We have seen with Project Dunbar, they've developed these prototypes for a shared platform that allows banks to settle cross-currency, cross-border transactions using CBDCs without correspondent banks. And they've done that by actually, giving those non-resident banks access to CBDCs, enable them to adhere to the local regulations in each case, which have been some of the obstacles here. So maybe Project Dunbar is a sort of feature we're looking at. And then in the securities industry, we're seeing lots of, at least 3 projects have succeeded in using CBDCs to settle securities transactions across border. Project Helvetia, Project Jura, and then this project run by Euroclear and the Banque de France to settle tokenized French Treasury bonds. So we are seeing CBDCs used to settle the cash leg, both of securities transactions and currency versus currency. So what is the answer to our audience members' question? Are CBDCs going to eventually dominate the world of cross-currency, cross-border payments? Angus?
Yeah. So there are obviously a lot of experiments that have been done in this space, as you talked about, but I think there are still a number of obstacles associated with it. The idea of a single platform, and I'm sure Daniel may have a different view, but the idea of a single platform that all central banks would effectively utilize is, to me, ultimately something that I just don't think is going to fly. And the reason for that is it gives away control around and supervisory powers, in essence, around the technology that embeds underneath the the digital currency that would be issued. It's not a coincidence to me that Bank of England is driving its own RTGS renewal program, ECB's upgrading its Target 2 program. If they seriously were thinking of utilizing a single global platform, I'd have to ask for digital currency, I'd have to ask the question, why is that investment happening in that way? So that's the one side. I think the governance piece that associates on top of that is hugely important. Central banks have a mandate to manage central bank currency, to manage currency policy. Their mandate as well is to ensure financial stability, and other regulators in each jurisdiction to cover consumer protection. Again, one of those focuses within that is around resiliency, and thinking about using a single platform for that on a global basis is it effectively introduces that potential single point of failure, pro-cyclical risk as well into the mix, and all of those things. And Godfrey mentioned as well the whole access question as well, as to who can access that single platform and who can't. So I think, the Holy Grail, obviously that's what it looks like. The reason why, for example, Finality's gone down the route of individual local payment systems in each market is entirely because over the course of the years, those discussions have been had with central banks, and that model we've put in place is to address many of those challenges associated.
And Angus, this might be a slightly unfair question, but I think I'm right to say Finality began as a sort of stablecoin project, if you like. What's your thought about stablecoins being used to complete cross-border, cross-currency payments? So you issue a stablecoin in one currency and swap it for a stablecoin in another.
So let me put to rest any misnomer that Finality is a stablecoin or has. And
I said it began.
Well, it began. So
coin that wasn't.
Yeah, but I think that the whole point about Finality and the whole USP that's different compared with a stable coin is, in essence, we are simply on our payment system a digital representation of central bank currency, fiat currency. The account that we hold it in is our account on trust, a trust account. So in the event, you have no risk against Finality in the event that we were to go into resolution, for example. And that is a huge differential compared with a stable coin that is in some form or other pegged to a currency or a basket of currencies. There is not that counterparty credit risk that exists around stablecoin setup. I think the other thing with stablecoins is, I think there's been a lot of conversation, a lot of interest in stablecoins, but what's happened over the last few months has really opened people's eyes to a view that says, a stable coin that's pegged to the dollar is not necessarily pegged to the dollar in the way people assumed it was pegged to the dollar. That introduces risk. And I think the reality is that stable coins, and we're already starting to see this, are going to be regulated as payment systems or under PFMI in one form or another if they're going to have to be used in a wholesale fashion across the industry. And therefore, getting up and running with a coin before you're regulated, again, we took the opposite approach, which was, get regulated first. It's taken a lot longer to get to market compared with where we'd hoped for, but get regulated first because it's coming anyway. You may as well meet the highest standards required of a financial market infrastructure. And ultimately, for the banks and participants, utilizing an asset on a payment system that has the qualities of fiat currency is going to be far more useful for them across a multitude of use cases.
So I'm happy to bounce back maybe some ideas against that. I think one thing when we think about a common platform, it's a little bit of a misnomer, and unfortunately we're working through the taxonomies of these systems. So it's nice to see where the gaps are and how we can update them. But we need to remind ourselves that this common platform is a distributed common platform. And that's super, super important. So when we think about, so we mentioned Project Dunbar, you mentioned Jura, and you mentioned Helvetia. There's also Project Enbridge coming out of Hong Kong as well, which is very similar to Project Dunbar, a little bit of a different participation arrangement. But what we're starting to see is if you can have a common settlement layer, right? If you can just ensure that settlement happens on the platform, then you can open up and just as thin a layer as possible on a common platform, and then everything else modularized to jurisdictions and currency types. There is a fighting chance that something like that can scale. Now, it's really interesting to think about how this scales. One common thing when you look at these platform arrangements is, Jura and Helvetia, both with Switzerland and France, are there's only 2 jurisdictions on that platform, but then when you think of Dunbar and Enbridge, we have 4 central banks and 4 jurisdictions, and 4 is kind of a sweet spot because you get the scale of kind of a multi-jurisdictional project, but you don't have to deal with governance and legal issues that are beyond that kind of extend out of the scope of what is possible. So I think once we get a handle on what are the commonalities and how can we run a system that works for 4 different jurisdictions, I think then we can start tackling the question of, do these things converge to a wider system that's adopted? Do they need to converge? Or is there maybe kind of a sweet spot around certain economic zones that can be the primary common system? And then at some point, these things can kind of roll up into another system that maybe looks at it from a little bit of a higher level, like central bank liquidity lines and things like that. To answer your question, maybe a little bit about the FX, will CBDC have an impact on the FX quoting, FX markets, and things like that? I think the answer is that it absolutely will. And my hope is that we'll be able to start to see corridors and currency pairs that don't exist today, and maybe liquidity in those pairs and business models around that simply haven't happened to date, because of the fundamental technology really hasn't been there.
We're into our last 4 minutes, in fact, and I know, Gottfried, you've got to go promptly at 3. So we've been asked a specific question by Henry Rashan, and he says, further to Gottfried's point, why do large banks still use rival banks for cash clearing outside their home market, even if they have their own office in, for example, New York or Tokyo? I know of one large bank where the CEO got cross 20 years ago when he discovered his bank was using Bank of New York in New York to clear US dollars rather than using his own US operation. Is this a matter of capacity, liquidity, cost, etc.? And I think you do say somewhere in here, there's like 15 banks ultimately intermediating every cross-border payment, because most banks are just doing local business and channeling it to into this relatively small set. So what's the answer to Henry's question? Why don't banks do more of their own business?
It's a good question, and I think you would have to ask the banks. And one I have asked the banks, and you get a mixture of liquidity is certainly a part. Their own subsidiary may not have as much liquidity as a Bank of New York will have, especially when it gets to dollars. Mm-hmm. Since the dollar is so crucial for all these flows, it only works if you have deep liquidity, which your own subsidiary may not have. Sometimes it's history, sometimes it's reciprocal arrangements where other services are provided on top of that as part of the correspondent relationship, such as documentary credit. There's a whole slew of services that are often included. So I think it is a mixture of liquidity, regulation, and custom commercial considerations. I would want to pick up though on the CBDC point for foreign exchange. Maybe 2 remarks. One, about the central banks working together. I'm completely with Angus on that one. I would also like to point out that we're moving into a world where it's not getting easier for central banks to move together. We're getting into a geopolitically fragmented world where there's deep suspicion, I think, between countries, and I can only name the US versus China as an example. There's deep suspicion about each other's CBDC programs and how it's going to be used. So for them to provide a common rails, I'm not sure that's very likely. So it may happen within blocks. And the other part of my answer would be, I think the battle for CBDCs will not be fought in cross-border. It will be fought in domestic markets. CBDCs will have to prove themselves domestically. They will have to find use cases, and then if they are used for those things, then I think they'll be used for Forex. But the other way around seems a bit like the tail wagging the dog. And then it really boils down to CBDC. Are we talking about retail, wholesale? What are the restrictions around it, etc.? So,
well, here's a good question. On CBDC, which major currency do you expect to do a full launch, not just a pilot first, rather big central banks always waiting for each other?
That's been answered, right? That's China.
Is renminbi a major currency? It's not even fully convertible yet. The question is really about euro, sterling, US dollar. What are the major currency pairs? I mean, perhaps there is no sensible answer to that question.
Well, the Europeans have shown their hand. They've committed that they will do it.
Mm-hmm.
We can discuss about the modalities, the time frame, and all these things, but I think they have committed to launch one. So
I think on that, Gottfried, I think they have committed, but I still feel, and it's just my view, that by the time it comes out, stable coins might kind of be so far ahead that it'll be very difficult for a euro CBDC to kind of compete. I mean, we've just heard and we've just seen Circle, one of the leading providers of stablecoin, come out with a euro coin, which is regulated, which is pegged to the euro reserves. And I think personally, I think Europe needs to kind of speed up the game if they want to be ahead. Otherwise, and just going back to that point around stable coins, I kind of agree with Angus that they need to be regulated. But I think I could see, because CBDC is at a global level, it's a global interplay. Plus, a lot of these different countries are at different stages. Some are very much in the research phase of CBDCs. Some have actually launched it. Some have actually dismissed the idea that they don't want a CBDC. I believe it could actually turn out, and that's my personal view, that stable coins become in place of CBDC. Stable coin take that chance and that space, with the central banks kind of having a partnership. So they might regulate it. They might say, well, we have got this visibility and we are looking into how these stablecoin reserves are pegged and do they have that kind of liquidity? And then that they use that because that infrastructure is already available. They have proven the concept. And I feel that could be something that we see in the future.
We're running over time, but I'd like to address a couple of last questions from the audience. And do go if you need to, Gottfried, but do stay if you can. The question's really initially for you, Daniel, which is, what's the difference between a single common platform and SWIFT here? Yes, SWIFT's a messaging layer, but banks have opted to join a single platform. That's one question. And then Miles Wright has also asked the question, Daniel, will that single settlement layer have mutualized losses? So there's a couple of questions there about the future. You were describing this decentralized, distributed, common platform, if you like.
Yeah. So I think the analogy between sorry. So your first question is,
yes, what's the difference between SWIFT and what you were describing?
Well, SWIFT doesn't have a settlement layer. SWIFT is only a messaging layer. So I think that making the analogy,
but you've got all the banks joining. You've got the 11,000 banks belonging to it. That's his point, really.
Yeah, and that's fine. But again, I think that a common messaging layer is very different than a common messaging clearing and settling layer. So maybe a more relevant analogy would be if you took SWIFT and CLS and merged them together, and thought about it a little bit more like that. And good luck is right. It's no small feat. But then at the end of the day, when you think about the value proposition of CBDCs and of digital currencies, that is the vision, right? So that's my answer to that. Then when you talk about kind of the exposure and the settlement risk,
mutualized losses, yeah. Will that single settlement layer mutualize losses?
Well, the question is, would the settlement layer and the operator of the settlement layer be a counterparty on the transaction and have associated risk that it would carry with it? And again, I would make the analogy to CLS and say that it likely wouldn't, the same way that CLS isn't a counterparty in the transaction either. So I think there is a way of creating a common settlement platform that can scale up to have the network effects of something like a SWIFT, at least from a theoretical kind of onboarding perspective, and not necessarily have the central platform operator, or dare I say, the distributed group of platform operators incur any financial risk or kind of counterparty risk at the same time.
Mm-hmm. Okay, we need to stop in a minute, but shall we just wrap this up with just a final thought maybe from each of you on what this future is going to look like? I mean, I'm carrying away from this, actually, the future is not going to be the rather neat vision which those 4 quantitative targets portray of a sort of a single corridor in which 75% of payments are made within an hour, and we all get to see the costs, and it's all very fast and efficient. It's actually a much more complex picture. Am I right, Angus? Am I right to think like that actually the future is difficult, fragmented, complex, messy, and how the hell do you regulate that to achieve these 4 goals?
So I think we've all discussed it on here to say you cannot generalize down to 4 criteria for every single type of cross-border payment flow. Ultimately, there are different solutions that are going to fit different types of activity. And yes, that's going to be existing type of activity, and it's going to be new type of activity that is still emerging. And there'll be a whole host of things we haven't even thought of yet that will come out of that too. Mm-hmm. I think, is it messy? Yes, there's going to be, there are those new solutions. There's new technology that's being applied that allows us to think about completely different ways of doing things compared with, 5-10 years ago. And it's right that the industry explores those because there will be, there's going to be efficiencies, cost benefits that come out from that, even if there may be in the short term, there could be a potentially greater costs that allow us to get to where we need to. I think the key is, though, there are standards that can be applied to make sure that within those new types of solutions, there are still standards that make sense, whether that be, the discussion around AML, KYC that could be applied, whether that be around ISO 20022. And there are also, I think people have to recognize there are red lines from a supervisory and regulatory perspective that those types of solutions need to abide by, and a recognition that if solutions are not regulated, they're going to get regulated, and therefore start thinking along those lines and meet the look to get to the highest standards in order for your business model to work into the future.
Gottfried, thanks for staying. A last word from you. You were very articulate at the outset about one size fits all isn't the answer here. You've got to distinguish between high value and low value. You've got to distinguish between business to consumer, consumer to business, and so on. What's the future of payments? Is it going to be John Falk's spaghetti land that we live in forever? You're on mute, Gottfried.
Thank you. Yep. Rookie mistake. The longer term, I don't know, but I think the medium term will indeed be messy. I think we're going through a Cambrian explosion with technologies. Lots of things still have to crystallize. I'm not sure it's going to be spaghetti, but it will be fragmented with different solutions for different payments. And it will be messier than now. But I do think the key role here will be the regulators, and they will be the ones to watch because they hold a lot of the responsibility and the powers to do something about it. I do think you have to put yourself in their shoes. We're messing not just with payments, we're messing with money, which is one of the pillars of society. And if you get that wrong, we know what happens, right? We saw that in Germany in the 20s, and we've seen that elsewhere. So they're keenly aware that they need to keep this thing going, because if it goes wrong, it goes spectacularly wrong. And they've been given quite immense powers to live up to those responsibilities. So that would be my view. It's going to be messy, but I would keep a close eye on the regulators, and especially central banks.
Anke, you've heard Gottfried say regulators are not natural risk takers. You hang out with the natural risk takers, the entrepreneurs who want to design and build better systems. Is there a tension between what can be done and what the regulators are willing to allow to be done?
Yeah, I think I kind of agree that there's going to be in the future, as I see, is that there's going to be a consolidation There's so many different technologies coming out. There's so many different ways to kind of achieve stuff. So you'll probably see a consolidation. Some of these technologies will exist, and some of these technologies will probably get to a point wherein there's no useful use case for that. Regulators will probably regulators are already trying to kind of come into the crypto world and into the blockchain world and trying to kind of dip their feet in. So I think there's going to be enhanced regulation coming in. As I said, as I spoke about the stablecoin piece or some of the cryptocurrencies, regulators will probably try and get more involved and more closer to that. So I see that happening. And I think the eventual one thing that I'll see is probably more and more adoption is what I feel around the crypto and the blockchain as we move forward. And there will be I think there'll be a place wherein both fiat and crypto exist hand in hand. And some of the big players, I mean, you talk about JP Morgan, Citi, Credit Suisse. The moment these guys start adopting crypto mainstream, which I believe will happen, we'll get even more messier before it gets better.
Daniel, a last word from you. I was thinking, listening to you earlier, that you sit down in July 2020, you read the 19 building blocks, you think, oh, that makes a lot of sense. That's a vision of the future which we can all subscribe to. But as soon as people start to get into the trying to implement those 19 building blocks, it suddenly starts to seem a lot less simple than that. And that's why we've ended up with this proliferation of working groups and reviews and technical advice and all the rest of it. Yeah, you've described a very clear vision of what you think the future will look like, that decentralized network of networks, if you like. But that itself is going to require considerable cooperation and collaboration. How hopeful can we be, given the difficulty we've had with the 19 building blocks so far, of achieving your vision in a reasonable timetable? By which I mean, maybe not the 5 years from now, but maybe 10 years from now.
I think it's hard to speculate on dates, but I think the direction of travel is definitely there, and the momentum is definitely there. I think the BIS and the BIS Innovation Hub are playing a significant role in driving this forward. I would urge not to think of private versus public sector at odds with each other in any sense. I think any significant accomplishments are done with public sector backing through private sector capacity, with of course proper regulatory oversight, and the regulatory oversight is incredibly important for public trust, not just when things are functioning, but most importantly when things are not functioning. And I think if the markets today show us anything, they show us how important that is. So I think the direction of travel is absolutely there. Again, I would focus on incentives. There are many moving parts, and ultimately it's the incentives of the different jurisdictions and the different private sector players within these jurisdictions to move our models forward in how we do business with each other, how we cooperate with each other, and how we connect different currencies and different economies together. So I'm incredibly optimistic about the future, and I think we can benchmark on today and see that we are making significant progress. And the competition is the competition and the diversity of players in the space is absolutely fascinating. The title of this event was, has cross-border payments lost its mojo? I just wanted to kind of circle back to that. Mm-hmm. In a way, it serves me very well that CBDC and cross-border payments is very sexy and topical. But at the same time, I yearn. I think we will know when we have reached some form of completion, when it becomes less interesting to talk about, because it just works. And I think that's where we are heading. I hear less people talking about blockchain and DLT and things like that, because people generally understand that there's a direction of travel, maybe not towards blockchain in particular, but in terms of distributed systems in general. I think as we think more about crypto and stablecoins and CBDC and all of these things, there's less of a question mark of, is this feasible? Because we understand that this is the direction of travel. So maybe it's a good thing when it loses its mojo, because it actually will be working.
When looking forward to a future in which payments are boring again, that's probably a great note on which to end. Because I think we must stop now. We've run over by more than 10 minutes. I'd like to thank our panelists, Daniel Eden from BIS, Angus Fletcher from Finality, Anka Sharma from BCB Group, and of course Gottfried Liaisons himself. He's sadly had to go, as we knew, but I'm grateful to all of them. I'm grateful also to you, our audience, for all the questions that you have asked and comments which you've made, which we have been very helpful to the discussion. Here at Future of Finance, our next webinar is on Thursday, 14th of July. In it, we're going to be looking at the impending regulation of the cryptocurrency and DeFi industries, and I hope lots of you will join us then. But for now, it's goodbye from the 5 or 4 of us. Thank you. Goodbye.
Thank you.
Thanks, everybody. Bye-bye.